I want to welcome everyone to the importance of cash flow. This is a very important topic, and you're set to learn quite a bit today from our presenter. We have Jim Dannhauser from the Cape Cod chapter of SCORE. They're part of the District of Massachusetts, Rhode Island, and we're very happy to have him with us today. And we also have a representative from our sponsor from Middlesex Bank, and we'll introduce him in a moment. But as we get going, we want to talk to you about SCORE in case you are not familiar with who we are and what we do. We are about sharing information with the small business community, and we do it in a couple of different ways. One is through the information on our website. If you haven't been to the score.org website, it does have a lot of information for you to access. There are templates you can download. There's videos you can watch, articles you can read. Certainly a lot of great information. The other way we share information is through our webinars and workshops. Most of those are advertised through our newsletter or through the website. We also post some key presentations to our social media sites as well. So if you want to follow us on any of those, then you'll get that information as well. The most important thing that SCORE does is the mentoring. Our mentors are volunteers that come to us from all different backgrounds. They have all different skill sets, and they want to share what they've learned with it through their careers with you. We work with folks that are trying to decide if small business is right for them. We're working with those in the planning phase, and we're working with those that are already have their business up and going. Perhaps they're just starting to grow and need to expand and want to figure out how to do that in the right way. Folks come to us asking about any business topic you can imagine, and we probably have a mentor that can help. We can work within our chapter, the district, or look on the national level to help find somebody that can help answer your questions that you have. So a beginning session is going to run in that 40 to 45 minute range, and they want to know what your goals are, what your challenges are, and they're going to help you come up with a plan to meet those goals. And the wonderful thing about our SCORE mentors is when you meet with one, you're meeting with more than one. Like they work together to help make sure that you get the information you need. They reach back to other members in the chapter. They bring others in to co-mentor. As your needs change, they may refer you to someone else. So it's a really collaborative effort to make sure that you can be successful. Getting a mentor, if you do not have one, is really, really easy. All you have to do is go to the score.org website. There's a blue box, and you can put your zip code in there, and that will match you to the chapter nearest you. And then there will be a couple questions, and that information will be used to help assign a mentor to you. It's a very simple process. So I strongly encourage you to take a look at that and consider getting a mentor if you don't have one. So we are going to use Q&A today, which is on the Zoom bar. It just allows me to not lose track of the questions, and we will try and answer some questions throughout and some questions at the very end. So go ahead and submit those at any time. Everything else can go into chat, but if you would like a question asked to Jim, then put that into Q&A. And we are recording, and that recording will be on the score.org/Boston website. As you can see from the graphic, look under the local workshops on the blue bar and drop down to previously recorded webinars. It will be there. I will also send a follow-up email after this presentation, so you'll have the link to any templates that are used today and information to our sponsor today, which brings me to Middlesex Savings Banks is with us today. We have David Bennett. He's the Senior Vice President. We're very happy to have him with us. He's going to be available to also answer questions. So if you have questions of David, please put those into that Q&A bar as well. And he will have some bio information here, but he's going to explain to us a little bit about Middlesex Bank. So I'm going to go ahead and turn it over to you, David.
Well, thanks, Teresa, and good afternoon, everyone. I'd like to start, of course, by thanking everyone about taking the time to join today's webinar on the importance of cash flow. And on behalf of Middlesex Savings Bank, we're delighted to be today's sponsor. For those of you that don't know, Middlesex is the largest independent bank in Massachusetts. And by independent, I mean we're a mutual savings bank with no shareholders. Now, this is a huge advantage that allows us to take the long view on things and to focus on our customers and the community while not having to answer to shareholders. We recognize there are certainly a lot of good banks in the market, and while we like to think we have some advantages, let's face it, most banks are pretty much the same. As they say, all our money's green. But what I can tell you are the reasons business owners like you come to Middlesex, and they also stay with us for a long time. And they become customers because they're frustrated by long selling cycles and slow payments that make their cash tight. As they grow, they become challenged with the need to invest in people, equipment, or processes. And they're anxious. They're anxious to work with a partner that works with businesses just like them. And some of this may actually resonate and sound familiar to you. Our bankers, well, they take the time to understand these issues. They work with the business to help solve them and be part of your team as you grow. Today's topic, the importance of cash flow, is critical to the success of every business. Your operating cash flow shows whether or not your business has enough money coming in to pay operating expenses. It can also show whether or not you have money to grow or if you need external investment or financing. Cash on hand brings stability and the ability to make better plans and decisions, and most importantly, gives you peace of mind. So our team can help in supporting your cash flow needs and introducing financing that may assist you. And SCORE can also assist on this journey. As a longtime supporter of SCORE, they're one of our go-to organizations that has a long track record with helping businesses plan to succeed. So I hope you enjoyed today's webinar and you walk away with some ideas and some lessons that you can make your own. And with that, I'll turn it over to Jim.
Thanks, David. Okay, folks, as Teresa mentioned, my name is Jim Dannhauser. I'm a Cape Cod and Islands chapter of SCORE. I've been a mentor for 10 years, and I've led a significant number of discussions about topics that matter to small businesses. And as David said, there is nothing more important to the continued success of your business than cash flow management. So what are we going to cover today? Just briefly on financial statements themselves, touch again briefly on startup costs and budgeting, but spend most of my discussion talking about cash flow statements, what they show you, how you put them together, and importantly, how you can use them as well as cash flow forecasts to make sure that you stay on top of your business's liquidity needs. Before I get to that, what is the objective of a financial reporting system? Well, you want to make sure that whatever system you have, whether it's QuickBooks, Excel, back of the envelope, pen and paper, whatever you do, you need to make sure that that is giving you accurate and complete information on a timely basis, because that's the only way that you can make better, smarter decisions about your business. And that key is accuracy and completeness. You need to avoid garbage in and garbage out, not just because it's inaccurate or incomplete, but because it can lead you down the road of making decisions that will really hurt your business on the long run. There are a couple of basic financial statements that most of you are probably familiar with. There's the income statement, also called a profit and loss. That shows the results of your business for a defined period of time, whether that's a month, a quarter, or a year. There's the balance sheet, which actually speaks of a specific date and shows the financial position of your business, what that business owns and what it owes as of the date that it speaks. And the cash flow statement, which, like the income statement, covers a period of time. And it shows where the business's cash has come from and where it has gone over that period. Sometimes you'll also hear people talk about a budget, which is an important financial document. It's not technically a financial statement, but a budget reflects the forecasted performance over the next period of time. And that is something that every business should be doing at least on an annual basis. As to startups, every startup has to prepare a cash flow budget. It should show everything it's going to need in terms of cash to cover its operating costs and development through the period of break even. And break even is simply where your revenues are going to be at least equal to your costs. And you should include a contingency in that, because in the history of business, no one has ever had a plan that turned exactly into reality. Things happen differently than you expect. And if you don't have a contingency, you'll find yourself up against it. But we do other webinars at SCORE that cover startups exclusively. So that's all I'm going to talk about in terms of startups today. Cash flow statement. It's the most important statement for your business. It shows what cash you need. It shows how much you want, because you need to think about how much you're going to take from the business yourself. And whenever you do one, you should stop and think about how it reflects reality. Now, we're going to talk a lot about how you use a cash flow statement to manage your business. You see referenced at the bottom there, a blog, which is quite good blog that very simply explains the calculation of cash flow. And it's a very useful tool for you to put in place and to have reference to. So what is a cash flow statement? It simply shows the movement in and out to your business of cash from all sources during the period it talks about. Cash from sales, cash from collections, investments, loans, sales and purchases of assets, operating costs, everything of cash that either comes into your business or goes out from your business should be captured in your cash flow statement. And that statement looks at those inflows and outflows over a specified period of time. And you should make sure that you are looking at your cash flow statement frequently. And as frequently, at least as monthly. Now, you see a reference there to score.org, their website. Now, Teresa mentioned this earlier. There's a ton of resources on that website, including templates and resources. And the 12-month cash flow statement sits there on that. And here's what that looks like. Just to give you a sense of what a cash flow statement would be. You always start a cash flow statement with what cash I have in the bank at the beginning of the period. And then it picks up every cash receipt, sales, collections, loans, or other cash in. Then it picks up all the cash that goes out for operating expenses, asset purchases, loan repayments, and then it comes to what the cash position is at the end of the month. So that's a basic cash flow statement. This template's available to you on the SCORE website, and I would encourage you to take a look at it because it's a very simple way, and you can fill it out yourself on an Excel spreadsheet. And it's a simple way to keep track of your cash flow. You've heard people always say cash is king. Well, there's a reason for that. It's true. In fact, most reasons that small businesses don't make it can be traced to cash flow problems. Running out of cash is simply death knell for a small business because you don't necessarily have the same number of options that larger businesses might. I used to say to people who worked for me that we could survive anything and fight another day so long as we didn't run out of cash. So you have got to stay on top of your cash resources and your current and future cash needs so that you can avoid a liquidity crunch. There are, fortunately, some simple practices that can really help you to do that. First off, you need to keep a separate bank account for your business. It's the simplest way to make sure that you are keeping track of the cash in and the cash out. You should run all of the receipts and expenses of your business through that account and none of your personal expenses. That way you can always see the ebb and flow of cash in your business without having to spend a tremendous amount of time trying to sort out what your personal expenses might be. I had a client once who just didn't do that. And I want to tell you, we spent at least 10 hours trying to pull out all of the personal expenses from that business expense to be able to take a true picture of what the business was doing. So keep a separate bank account for your business. And if possible, get a separate credit card for your business. Use it only for business expenses and not personal. Again, it's a way to keep things separate. It's a way to clearly see what's going on. It's a source of potential credit for you, which I'll talk about in a little bit, but be careful because it's expensive if you don't pay that credit card back promptly. But it also helps your business to begin to establish a credit, which is an important thing for you to have to start. In addition, as I said, you should look at your cash flow statement at least monthly. You should keep a cash flow forecast for the next 12 months and keep it updated. And I'm going to spend a fair bit of time talking about cash flow forecasting. You should maintain good accounts receivable collection practices because in many small businesses, accounts receivable is a significant management challenge, and we'll talk some about that. And you should avoid overdoing it on supplies, inventories, and equipment. Buy what you need, have what you absolutely need on hand, but don't overdo it. I've seen many businesses, in the retail business especially, who overstock on inventory. It eats up cash and puts them into a potential difficulty. So let's talk about a cash flow forecast. You should prepare one each year as part of your annual budgeting process. And you need to update it every month or more frequently if things are turning out differently, because you need to reflect what actually happened to be able to anticipate what will occur over the immediate, intermediate, and term and over the next 12 months. And if you see real cash shortfalls, you need to start acting, and we'll talk about that. But don't wait. If you see them over the next week and month, take steps to deal with those immediate issues, because things change and you need to reflect the impact of those changes. You can't make smart decisions about your business. Should I add staff? Should I buy equipment? Do I need to reduce expenses? Can I afford to take on work? Unless you can see what your cash situation is going to be over the next 12 months. And this is important, particularly for people on the Cape, but you need to bear the seasonality of many businesses in mind. I've seen clients who are very happy with how great June, July, and August were going. But in my experience, at least so far, every year also has a January, February, and March, when business may be much slower. So you need to make sure that you are husbanding your cash resources to cover those down or slower periods. And if you see a cash shortfall on the horizon, take steps to deal with it early. Seek working capital or other loans. You may need to reduce expenses, including staff. You may need to delay purchase decisions or accelerate collections. And you should try to keep cash reserves and or establish a working capital line of credit to help you to deal with shortfalls. Now, I'm going to show some sample forecasts for a few minutes and talk through them so that you can maybe better understand why it's so important that you keep an updated cash flow forecast in hand. This is a sample company. It's back in 2020.
We're not seeing the sample. We're just seeing the PowerPoint slides still.
Ah, okay. Better?
No, I'm still seeing PowerPoint slides.
now.
No, sorry, still PowerPoint. You might have to share a different, is it a different screen or?
Well, here's what I'm going to do.
I don't know if you had two, I don't know if you had two.
Yet,
No, did you, when you did the share screen, do you have, are you using two monitors or are you just using one?
no, I'm using one monitor.
Okay, so when you did the share screen, you must have just picked to share the PowerPoint, not your computer. So you just need to stop share and share the either the whole computer or share the Excel app or program. So you might have to yeah. So if you do the share screen, yeah.
Does that now work?
Let me see. Yep, we've got it. Thank you.
Okay, great.
Perfect.
Okay, sorry for that long journey through the Zoom minions. So you see this cash flow budget was done back in 2020 for this company that started the year with $51,000. Their cash flow budget was to generate $275,000 of inflow and to have a positive net cash flow for the year of just under $60,000, which is great. Okay. And each month, as you can see at the bottom, it continues to be a very significant positive. So all is good and right with the world. But then reality comes. Now, obviously, this reality was severe because it's when COVID hit. But it makes the point that if you simply do your cash flow budget for the year, your forecast, and put it on the shelf and don't update it, then you're going to be in a real world of hurt. So you see, suddenly in April, the cash inflow is only $2,200 instead of the $20,000 or so that it was doing. And very quickly, this business is going to run into negative cash flow. So it needs to take steps to deal with that. Does it reduce the amount that the owner is going to take, which is $5,000 a month? It may need to reduce headcount. And, you know, that's always a challenging thing to do in a small business. But realize that you are not doing any of your employees a favor if you don't take the steps as a manager to make sure that you keep adequate liquidity resources available. There are other things that you can do. You can cut down on marketing expenses. You could slow down on inventory purchases. But if you don't react, you're going to find yourself in a position where you have these very negative cash balances. And that is, as I said, a death knell for a small business. I have another that I hope I can show. You seeing that, Teresa?
Yes.
Okay. This is a simpler cash flow forecast. You see down at the bottom a reference to a YouTube video. Now, I know that people think that's crazy, but I'm telling you that if you want to find out how to do things, going to Google, YouTube, and other search resources is very valuable. There's an excellent video that I referenced there on how to accurately project your cash flow, your complete guide, and I encourage you to take a look at that if you're having trouble. This is a very simple format, but it tells the story of a business that started with $20,000 in the bank. It ended with $11,000 in the bank from their forecast perspective, because they brought in 700, had 709 went out, which is a $9,000 negative. But if you look here, they are in March at a negative $11,000. Now, these are not big numbers, but they make the point as to how it can affect your business. You've got what happened? How did they get to the $11,000 negative? Well, you see, they made some significant inventory purchases in the first 3 months of the year, probably gearing up for the season. But if this business had done a full cash flow forecast, they would have seen that that expenditure would have put them into the negative. And they wouldn't have done it. They could have done any number of different things. They could have taken advantage of a working capital line of credit and drawn on that to buy that inventory instead of laying out the cash. They could have used a credit card to buy that inventory instead of using the cash, and pay that back when they get into the positive cash flow period. All things that are possible, but if you don't have a timely cash flow forecast that you can use as a resource, then you're going to find yourself making decisions that can get you into trouble. Again, you'll see that it turned negative again in June. Why? Well, in June, they bought $20,000 a piece of equipment. That is not something that you would need to do if you knew it was going to turn you negative. What could you do? Well, you could talk to that equipment supplier about buying the equipment on credit, at least for a period of time, or leasing it. Oftentimes, equipment suppliers are the most ready source of financing for a small business. So that is something that you could do to take advantage of available funding for you before you get yourself into a position where you have a negative cash flow. So now I'm going to have to go back to find the presentation. Can you now see the PowerPoint?
Yes, we see the PowerPoint. It's on the first slide.
Great. Okay. Again, the gremlins got me, but they always find a way to do that. So that's what I wanted to talk about on a cash flow forecast basis. Understand its importance, understand the need to keep it timely, and understand the need to anticipate what problems you might be having and what opportunities you have to address those before it gets too late. Talk about accounts receivable, because for many small businesses, these are significant management headaches. They can cause significant liquidity problems, so you need to develop and maintain good accounting practices to deal with your accounts receivable. What do those include? Timely billing. You should get your bills out as soon as the work is done and clearly state what's been done, what's owed, and when payment is due. Most businesses will have an accounting system and it will have an invoicing tool that makes it very easy to do this. And I can't tell you the number of times I've dealt with clients who simply didn't get bills out on time and were wondering why they had significant accounts receivable balances. Manage it, and you can avoid that problem. We would recommend that you send them both by email and regular mail, because many times emails that you send to clients will get caught up in their spam or promotion folders, or they may say they did, even if they didn't. You should make sure clear how checks should be made out and where they should be sent. And if possible, allow for online paying or credit card or debit card payments, because that will significantly decrease your collection problems. And get to know who actually makes payment, or have somebody in your organization get to know who's making payments from the customers, because that's the way that you can communicate rapidly with people. Monitor the collection process. Most of your accounting systems will enable you to do that very quickly, or have somebody else in your organization do this. And make sure that you get reminders out if payments are late. Reach out to people, because that is, at the end of the day, your money. You don't want to get a reputation for hounding people, but you want to make sure that you have appropriate collection procedures in place. You might consider a formal letter or legal action. I have one client who insists upon doing that whenever somebody doesn't pay them, but remember that there's expense involved. It's your time or somebody in your organization's time. There's costs of going to court, even small claims court. So check the ability of your customer to pay you and be prepared to cut the price and collect what you can. But by all means, don't continue to do business with customers who aren't paying you. You might also consider early payment and prepayment discounts. Why? Well, I have a company that takes care of a sprinkler system in my yard. And each year they give me the opportunity to pay the full year's base fee in advance and offer me a 5% discount. I do that because I'm not earning that much money in my checking account. They do it because it gets them out of the collection problems and also gets them a little bit more cash during a slow period. Now, I know you'll have people will say, I offered a 20% discount. That's way too much in my humble opinion. But if you can encourage people to pay you in advance with a 5% discount for the full year's payments, it's well worth doing because you then do not have to worry about going out with the collection process. And you can now readily get credit card authorization from regular customers, and just be careful with that information because you do have to protect it. Some other working capital tips. Working capital, by the way, is a fancy term for your current assets, cash, receivables, and inventory over your current liabilities. What are you going to have to pay in the short term? So you should avoid putting stress on your working capital. Don't overbuy inventory, supplies, and equipment. I know that everybody, particularly in the retail space, wants to have a full supply of the available inventory for sale. But don't overdo it. I've seen so many clients over the years get into a situation where they simply overstocked and then they had the inventory and it sat. If it sits for a time and you overbought, be prepared to mark it down and do whatever you can to move it. Because if it hasn't sold in the normal period of time, it's not going to sell unless you do something to move it. And that is effectively your cash sitting on the shelves. So you're better off getting it moved and improving your cash position. And whenever you're buying something, David earlier mentioned financing for growth. People sometimes don't understand that if you want to grow your business, that's typically going to include some level of investment, whether it's for additional equipment, additional people, additional locations. So make sure when you are doing that, whether it's that or any other purchasing decision, that you're keeping the impact on your cash flow statement in hand. Pay your accounts payable on time. You don't have to pay them early. If you have somebody who gives you 30 or 60 days, pay the bill within that time period. I know everybody wants to be a good customer and make sure that you have good service from your service providers, and you should do that by all means. But pay them on a timely basis. You don't have to pay them the day you get the bill. And I put this in block letters because it's very important. If you have sales or meals taxes, or you have employee tax withholdings, that is not your money. Make sure that you pay those dollars over to the appropriate authorities in the time frame that they're due to be paid, and don't use them otherwise. I have seen people from time to time get into a situation where they felt tight on cash, and so they dipped into those funds, figuring they would pay it back when things got better, and they didn't. And you can find yourself in a situation where you have significant penalties and interest attached to you. So by all means, don't use those funds as yours. Part of managing your cash flow is making sure that you are aware of what sources of financing could be available to you. You see listed here the typical sources that you might have available to you in a small business. Everybody, when they're starting a business, thinks about talking to family and friends. You may use your personal savings or assets. I've talked about using credit cards, and they can be available. Many small businesses, that's almost the only source of credit available to them. But they come with a high cost. So make sure that you pay those amounts back on time or just as soon thereafter as you can, because otherwise you're paying a very high interest rate. Bank loans. Bank financing can be difficult, particularly for startups and small businesses. And I have often said to people who I'm mentoring that their best bet in seeking bank financing is not necessarily to go to the big money center banks. It's to go to the community banks, the neighborhood banks, financial institutions like Middlesex, who are more accustomed to dealing with small businesses and their issues and challenges than the larger ones might be, and you can have much more productive relationship. SBA financing is often available, and many of the financial institutions I mentioned will also use the SBA as a backstop in their financing. And certainly you should look at all of those programs. And there is equipment financing and leasing, as I mentioned, that is oftentimes a very ready source of financing for a small business. Why? Because the equipment manufacturer is comfortable if they have to take the equipment back because you can't pay them. You'll hear people talk about online lenders, and they are there. They can be very useful, and there's a long list of them. But recognize that while they are quick to act, they are also not inexpensive. Between the fees and interest that gets charged, you can end yourself with a very high APR. So they are available. You should consider using them, but you should also not forget to talk to your local neighborhood, community, and savings banks and credit unions. People talk sometimes about crowdfunding. That is a very difficult road to hoe. You have a significant amount of work that has to be done. You'll need videos, you'll need follow-up, and it's usually available for very special cases, whether it's health needs, particular problems that small business might have that is a big part of a community, but it's very difficult to get for the average small business. So what will a bank look at if you look for financing? Well, first off, they're going to look at your personal credit typically. And for most small business loans, banks are going to be very concerned with what I call these 5 C's: collateral, character, conditions, capacity, and capital. They're going to look at your personal credit. They're going to want to understand what assets might be available to secure repayment. They're really going to want to understand how well you understand your business and why it is that you're going to be successful. So you need to have a good business plan. You need to reflect your understanding of that business plan and the challenges. And you need to show that you have the real ability to be successful in your business. But if you do that and you are prepared, and I would recommend in part of your preparation that you work with a SCORE mentor, because they can help you get all that together, then you can find a very ready audience at an appropriate financial institution to get financing for you, whether that's financing to start a business, which is the most difficult, financing for an existing business, and particularly a working capital line of credit. Suggestions: establish the banking relationship early. Remember, I said you should have a separate banking account for your business. Well, when you do that, don't just go to the teller and try to open up a checking account. Have a meeting with a bank officer and establish a relationship. Have them understand what your business is and who you are, and meet with them periodically, because bankers are always ready to meet with you. Why do I suggest that? Well, because if you find yourself at some point in time needing financial assistance, you're much better positioned to be able to achieve that if you're not going in on a cold call basis for the first time with a bank, as opposed to meeting with the banking officer who has met with you before, seen the results of your operations, seen your business plan, and is therefore much more comfortable with what you're looking for. You can establish merchant credit for supplies. You can consider working capital financing. Now, what does that mean? A bank or a lending source making working capital financing promises to loan you up to a certain amount of money as you need it. So if in a particular month you find that you are short of money, you go to the bank, you have a working capital line in place, and you can borrow an amount of money. You'll be charged interest on that. You'll be charged a commitment fee for that. And you will typically be required to pay that back and keep the working capital financing at a zero balance each year for a specific period of time, which will be something that's negotiated. But having a working capital line of credit available to you is a tremendous tool to give you surety that you are not going to find yourself unable to deal with a short-term cash flow issue. And make sure that you are constantly working on establishing a good track record for your future needs. And Teresa, that's what I had to say. So we'll open it up to any questions that anybody might have, either for me or for David.
Yeah, you can put those questions into, at this point, we could put them into chat, since we don't have any more presentation to go. So please go ahead and get those questions into the chat or the Q&A so we can get those answered for you. While we're waiting for people to type, David, can you tell us, does the bank want to see a cash flow information on a new business that's come to talk to you? Is that important too?
Well, a brand new business, yeah. One of the things would, if you're a new business, newly established business, we will look for projections and incomes of an income statement, a balance sheet, and a cash flow statement of 12 to 18 months, like Jim mentioned. Really established businesses, we don't ask you to prepare a cash flow statement. It's one of those things you should be doing on your own. We look at really the income statement and balance sheet, tax returns, things of that nature. As we get dealing with companies that are a little bit more of a track record, more substance, more size, we'll actually prepare our own cash flow statements based on the information that you provide. So it runs the gamut, really. It depends on where you are in that circle of development and how much money you're looking for, how long you've been around.
Okay. We have a question. What are some examples of invoicing tools that would work with our existing QuickBooks program?
Well, QuickBooks actually has one itself, which is the easiest way to do that. Most frequently will enable you to do everything that you need to do. And then it automatically will be kept track into the accounts receivable. So the easiest way to do that is to use the QuickBooks invoicing tool.
Yeah, and you should be able to set up your own layout with your own logo. You should be able to email those invoices or print them to mail. Yeah.
Correct. And then it automatically hooks into the accounts receivable portion of your QuickBooks.
Right. It helps you keep track of how long it's been open, that kind of thing. Okay.
Right.
By working capital financing, do you mean a business line of credit?
Yes.
Great.
And a follow-up on that accounts receivable question, the other thing that you can do in QuickBooks is you can go into the accounts receivable and you can see an aging analysis. So you'll very easily see anything that is more than 30, 60, or 90 days. So it makes managing those a little bit easier than it might otherwise be.
Great. I'm not seeing any other questions. But if you do think of a question later, you can actually put my email into.
While you're doing that, Teresa, I just want to add that,
yeah.
you know, that's one thing we see. A lot of folks are very good at whatever they do for their business, but don't let the financial side of the house suffer, or don't avoid paying enough attention to that important aspect of running a business, because no matter how good you are, the accounting side can trip you up over time.
I would echo that completely. The other thing I would say is that if you find yourself just not doing it, figure out a way to do it, whether that's using an outside resource like a bookkeeper that could be available to you. But you will find yourself being much better about your business if you understand the finances. And if you just don't like it, That's not why you got in business for. Well, pick the things that you're good at, but make sure that you're keeping track of your cash. And then if you need to use an outside bookkeeper, go ahead. I'm going to throw my email address in the chat as well for people who have follow-up questions.
We do got a couple more questions. How can a company be a positive cash flow but negative profit? Is that a possibility?
Yes. Here's how. There are certain things that hit your P&L that aren't cash. For example, if you in your business you own a building, you're going to have depreciation expense associated with that building. And that does not affect your cash flow because it's a non-cash expense, but it does affect your P&L. So that's one simple, straightforward example. You'll have other expenses that will be amortized over time. So for example, if you do buy another business, you'll have typically goodwill associated with that business, which will be amortized. That will affect your P&L, but it will not affect your cash flow. So yes, you can look at your profit and loss statement and say, this is great. I'm in the red. And then you look at your cash flow statement, you can be in the black, which is why it is very important that you keep an eye on the cash flow.
Yeah, I have a question. Any tips for managing cash flow for a rental fleets, or where resources for rental fleets can be found? And this is really where a SCORE mentor comes in, because they can look at specifically with your business and talk to you about your cash flow and budgeting. So that's really where a SCORE mentor would come in. So I really strongly suggest you reach out for someone. My business goal is to have a laundromat. I don't know how much money that will cost. So is someone available to assist me with all the costs?
Again, I would strongly recommend that you get in touch with your local SCORE chapter and get a mentor. The other thing that you can do is that you could, there's a company called BizStats, which has information about other businesses in your area. You can also talk to people. Go to a different neighborhood and see if you can find the owner of a laundromat there and talk to them about how much it cost them. But above and beyond all of that kind of due diligence, my suggestion strongly is to seek out a mentor from your local SCORE chapter. Yes, it's BizStats, BIZSTATS.
Looks like we have a few more questions, Teresa, in the chat.
Okay, great. I have all the pieces in place: QuickBooks, bookkeeper, accountant, but who would I work with to actually keep me putting all those pieces together by helping me prepare a budget and cash flow statement, etc.?
Okay, as to the cash flow statement, that is right out of QuickBooks. So it is something that you can run right in QuickBooks. And if you have a bookkeeper and an accountant and they can't generate a cash flow statement out of QuickBooks for you, then you need to get a different bookkeeper or accountant. It's a very simple process. The cash flow budget, that is something that you need to start. I don't know if you're starting a business or if you have an existing business. I'm assuming that because you have these pieces in place, you have an existing business. Your budget is going to be based on history. What revenue did you generate last year? What expenses did you have? And that, unless something dramatically is changing, that is going to be the base case that you will look at and figure out what you can do to make a difference. If you're just starting out and trying to put a budget together, well, the one thing you can be pretty confident in is what are the expenses? And that's where I would always start. What are the expenses that I'm going to need to incur in order to get this business up and running? And you should know that because it's your business. And again, if you can't quite figure it out, you could work with a SCORE mentor, because all businesses have a different expense profile. And you go and you have a meeting and you talk about what it is that you're trying to do. And that's where a SCORE mentor can really help you to pull the pieces together.
Okay. This person says, we use QuickBooks and manage our business on an accrual basis. Will the QuickBooks cash flow tool give me an accurate financial picture, or do I need to create a cash flow model manually?
Well, there's two things here. One is QuickBooks looks to the past, it doesn't look to the future. Okay. The QuickBooks, you will keep your books on an accrual basis, but when QuickBooks gives you a cash flow statement, it actually is doing it on a cash basis because it's making the adjustments to your P&L to modify the impact of accruals to show what the actual cash in and cash out was. So that's what QuickBooks will do you. When it gives you a cash flow statement, it is actual cash. To do a forward-looking forecast, QuickBooks won't do that for you. You need to do that yourself, but you can generate that, as I just mentioned before, off of the actual historic cash flow statement, which will show you what you can expect over the next period unless things are changing.
Okay, I think we've hit all the questions. So I want to thank Jim for a fantastic presentation and David for his insight from the banker's view. And I definitely, again, want to strongly encourage you to reach out to SCORE and get a mentor to help work on this with your business specifically. We're happy to do that. And thank you, everyone, and have a great rest of your day.
Thank you, everyone.
Thanks, everybody.